Welcome to today's video where we'll uncover the truth about 401k loans. We'll cover the pros, the cons, and most importantly, the major risks you absolutely need to avoid. So if you've ever considered borrowing from your 401k, you probably heard conflicting advice. Some say it's a smart move, while others warn it could be a financial disaster. But here's the reality. While a 401k loan can seem like a quick solution, the risks involved can severely impact your long-term financial future if you're not careful. So in this video, I'm going to break it all down, how a 401k loan works, the benefits that might tempt you, and the hidden dangers most people overlook. And by the end, you'll have a clear roadmap to help you decide whether borrowing from your 401k is really worth it or if it's a decision you'll regret later. So let's get started by understanding exactly how a 401k loan works. A 401k loan allows you to borrow from your own retirement account. Typically, you can borrow up to 50% of your vested balance or a maximum of $50,000, whichever is less. If your vested balance is under $10,000, you can borrow up to that full amount. The loan is pretty easy to set up. Most plans allow you to apply online, and since it's your own money, there's no credit check involved. And within 2 to 3 days, a check is literally sent out to you, giving you the quick access to the funds. But here's the catch. Once you take that money out, it's no longer invested. Before you can request the loan, you're required to sell your investments within the 401k to free up that cash, which means those funds aren't growing or compounding over time. If the market has been doing really well, this can cost you significant returns over the long term. Now, once you have the loan, you need to pay it back, typically over 5 years. If you're using the loan to buy a home, the repayment period can be extended longer than that. But regardless, you'll pay yourself back with interest because you're paying the interest back into your 401k account. But the reality is you're really repaying the loan with after-tax dollars, money that you already paid taxes on. And later down the road, when you withdraw those funds in retirement, you'll get taxed on that money again, essentially double taxing yourself. And here's where it gets risky. If you leave your job, change jobs, or get fired, you may only have 60 to 90 days to repay the loan. If you can't, the loan will be treated as a withdrawal, meaning you'll owe taxes and possibly a 10% penalty if you're under age 59 and a half. Now, you might be thinking, well, that's all bad. Are there any benefits? And sure, there are a few that I'll point out right now. First, it's quick and easy access. If you have a financial emergency, borrowing from your 401k can provide fast cash, especially if other options are unavailable. There's no bank involved, there's no credit check, and the process can be pretty simple. There's also no penalties or taxes if you do it correctly. As long as you repay the loan within the planned terms, you won't face any penalties or taxes. Interest goes back to you. Now, you do pay interest, but that interest goes back into your 401k. And also the interest rate on 401k loans is usually much lower compared to taking out a credit card. You can prepay the 401k loan without any prepayment penalties by sending money into the plan. Now, the most common way it's paid back is through payroll deductions, but you can submit check payments into the plan, or you can submit payments online through your bank account. In general, borrowing from your 401k should be a rare occurrence, but it can make sense if you find yourself in the need of a meaningful amount of cash in the short term. Moving on, let's address the major risks of borrowing from your 401k. The biggest downside is missed investment growth. The money you borrow isn't invested in the account anymore, so there's an opportunity cost. When markets are performing well, this could mean losing out on significant returns over the long run. Remember, a dollar you borrow today is a dollar that's not compounding over time for your financial future. Then there's the issue of double taxation. As I mentioned earlier, the money you're paying back into your account comes out of your paycheck after taxes. And then later, when you retire and withdraw the funds, those same dollars are taxed again if you contributed on a pre-tax basis. This can really eat into your savings over the long run. Things get even trickier if you leave your job, whether voluntarily or not. You're expected to pay back the full balance of the loan, typically within 60 to 90 days. If you don't, the loan is treated as a taxable distribution, and you'll owe income taxes plus a 10% early withdrawal penalty if you're under 59 and a half. So imagine you're in the 25% tax bracket, you take out 20 grand, and then you're let go from your job, or you're just unable to pay back the loan. You have 60 to 90 days to pay the 20 grand back, Plus you owe the IRS an additional $5,000 in taxes and $2,000 in penalties. That's $7,000 gone just like that. That's a steep price to pay for your own money. Another thing to keep in mind is reduced retirement savings. Every dollar you borrow is a dollar that's not compounding in your 401k. And for many people, repaying the loan and continuing to contribute to their 401k can be challenging. If you stop contributing during the repayment period, you're stalling your retirement savings even further and potentially losing out on your employer's matching contributions, which again, that's leaving free money on the table. So before you decide to borrow from your 401k, it's important to ask yourself some serious questions. Do I truly need this right now? Is it a necessity or is it something that can wait? If I took out a 401k loan today, will I have the cash flow to pay back the loan and maintain my 401k contributions? Now, if you have a stable job and your household is bringing in a consistent income stream, a 401k loan can work for you when short-term emergencies do come up. But if you're not in a stable job or your income is not very consistent, you just need to be really careful. There are alternatives out there to consider. There are things like a home equity loan. If you own a home with at least 20% equity, this can be a lower interest option. There is personal loans that don't require collateral, but the interest rates are higher and you can't deduct the interest rate. There's also credit cards with 0% APR, but I would only consider this if you're confident you can pay off the balance before the interest rate kicks in. So sometimes the best financial move is to simply wait until you have more saved up rather than getting locked into a new payment or tapping into your retirement savings. So given the benefits and risks we just discussed, a 401k loan may work for some people, and for others, the long-term risks often far outweigh the short-term benefits. Thank you all so much for watching. If you found this helpful, please subscribe to the channel, and I will see you on the next one.